I'm going to start off the presentation or this block with my presentation, which, as you can see, if I go back to the title there, is the current picture for gold. That's a pretty boring title for this presentation. I tinkered with the idea of calling it a horror movie for gold bugs, but decided that might be a bit too depressing. But that said, this is kind of a horror movie for gold bugs. And unlike a typical horror movie, I'm going to dispense with all of the character development and get right to the carnage. So let's take a look then of the gold price. This is a long-term chart of the gold price, 20-year chart going back to the early 2000s bull market. And I'll put this up to give you some perspective, of what this correction that we're in, as steep as it's been, as depressing as it's been, how it kind of steps up or marks up against the previous corrections from these long bull markets. And as you can see, on a big picture perspective, it's not unprecedented. It's not that out of the ordinary. And in fact, it is to be expected. We've had similar types of corrections, in particular back in 2006, 2007, and even on a relative basis early on in 2003 and 2004. And of course, that was a very long-standing, very profitable bull market for gold and silver investors, and especially investors in junior mining stocks. The moving averages we show here are the 300-day and the 400-day. These are not the typical 200-day moving averages. I found long ago that these longer-term moving averages are better in trying to pick out the very significant support lines. Typically, the 300-day has been very good in being a line of support, line in the sand for the gold market. As you can see, throughout that long bull market, gold periodically and routinely bounced off that 300-day moving average. As you can see, though, especially if we zoom in a bit, you can see that we broke through that 300-day moving average. And in fact, we broke through it not that long ago. What you see here is that the longer standing support at the 400-day moving average seems in this chart not to be approaching, but in fact, over the last couple of days, we did break through that. So yes, a depressing picture. Here's a chart from my friend Ron Grease at thechartstore.com. He does a number of our charts for Gold Newsletter and does a great job. What you'll see in this chart is a long-term support line stretching across previous market bottoms. And this was a key support line that Ron marked in his last week's chart blog at 1735 to 1750. And of course, we have broken through that as well. Here is gold's 14-week stochastic, again by Ron at the Chart Store. This is something I've tracked very closely over many years. I found it to be a wonderful indicator of really momentum, price momentum in a market, in an asset class, particularly for gold, silver, and the other metals. What you see here is at the very end here, we were going up, and then before we reached a peak or reached around that 80 level on the stochastic, we turned right back down. Again, this is not unprecedented. It's happened before in that long bull market of the 2000s. However, it is rare, it is unusual, and it certainly is not bullish. Here we see that silver is performing much better. In fact, Ron notes as of last weekend when he did this chart that the indicator was still neutral and wasn't in a sell mode or delivering a sell signal. This, of course, is a 14-week stochastic. It's a little slower moving than in a broader view than the day-to-day fluctuations in silver. Anecdotally, I think we can all realize that silver has been outperforming gold, even though it has been heading downward. I would think if this chart were, or when Ron redraws this chart next weekend, this coming weekend, that silver will have probably also delivered a sell signal at that point. Copper is an exception to the rule here. Copper is performing quite well. We using this stochastic right when it made this last turn upward in late July, we called a new copper bull market in Gold Newsletter. And it certainly played out that way. The copper price is up over 30% since then. It's been down in recent days, correcting a little bit, but it's still very strong relative to gold and silver. However, the copper juniors and really copper stocks in general haven't been reflecting this, or haven't been factoring or discounting this move upward in copper prices as they should. I believe, I'm a firm believer and observed this over decades in the market, that you don't have a bull market in copper stocks or zinc stocks or anything else unless there's an underlying gold bull market and bull market in gold and silver stocks to bring investors into the sector and bid up these ancillary metals, at least in the equities associated with those metals. So before these copper stocks start to reflect the higher copper values, we're going to need to see the gold bull market get back into gear. But they do represent, in light of these much higher copper prices, they do represent exceptional values right now. So what killed the gold bull market over the last couple of months? We broke out of the gate the first couple of days in 2021, and then we were summarily trashed. Gold was, and silver went along. The easy story, of course, is treasury yields and real yields leapt higher. At the top, you see the 10-year treasury. You see it rose and had been rising throughout the end of last year and into this year, and had a couple of upward blips that essentially, as you see, knocked gold for a loop. Right here, you can see that the real yield did not always respond to the 10-year treasury, but it has recently, as inflation numbers or inflation expectations weren't able to keep up. So yes, gold sold off, as you can see, these blips upward. And if we focus in, we can see it more closely. There was a blip upward just a couple of days into the new year, and the 10-year yield and the real yield and gold took a big hit initially, and subsequently, as yields continue to rise toward that critical, as we've seen 1.5% area on the 10-year, it was not able to recover. Our friends at Incrementum, who put out the In Gold We Trust report, really the best annual report on gold in the market, just came out with their chart book today, this morning. So I was able to throw some of them into this presentation. This is a wonderful illustration of what I just discussed, because what they're doing here is inverting the 10-year yield. The 10-year yield is in gold. The gold price is in blue. And as you can see, they are nearly coincident with that rise. Again, this is inverted, rise in the 10-year yield and the fall off in the gold price. Essentially, what was happening was the enthusiasm, the bullishness in gold was at such high levels that it didn't take much to trip it up. And rising 10-year yields certainly was a hammer, where a hammer really wasn't needed to derail the bullish argument for gold. This is a similar chart inverted for real yields, and you can see it was coincident. And if you're looking for an excuse for gold's drop since the early days of the new year, that was it. As far as a long-term view, here is a 14-month stochastic. Now, our recent stochastics were 14-week. This is a 14-month stochastic, a much broader view, longer-term view, and it gives us an idea of broad, grand sweeps in the markets. What you see here is that, and this is something we've been reporting on in Gold Newsletter, yields did turn up, and we do have what looks to be a longer-term uptrend and kind of a secular shift in the market. So I would expect that yields will continue to rise, not just for the next few weeks, but really over the next year. Another chart from the chartstore.com. This shows the yield curve across the entire curve for treasuries and on a real basis, again, an inflation adjusted basis, simply subtracting the CPI, the inflation indicators, from the yield. as you can see, yields are higher this week or this past week as opposed to a month ago, and considerably higher than 52 weeks ago. And 52 weeks ago was really before we had all of that volatility due to the onset of the pandemic. So this trend was already in place. 52 weeks ago, we already had a lowering Treasury yield, dropping Treasury yield, and a very low and really negative across the curve Treasury yield before the pandemic even hit. So the pandemic and its policy measures resulting from that certainly added to trends that were already in place. Here's gold in its 14-month stochastic. And this is, again, important in that this is a broader, longer-term view of the market in the grand sweep of the trends. And what you can see here circled to the right is this 14-month stochastic turning down. That reflects the past few months of declining prices. Again, this is not unprecedented. We've seen that before. It does not kill off the bull market theme at all, but it does test your mettle if you're a gold bull and a gold bug. And it is, at least initially, bearish indication. So what's going to change this? What's going to get gold back on track? Simply put, the fundamental story for gold, the fundamentally a long-term bullish argument for gold is really unprecedented in modern times. This chart shows the Fed's QE programs really going back to post-2008. And if you go from bottom upwards, you can see the first QE1 was somewhat moderate, lasted a while, but it didn't have that much of an effect. QE2 was much steeper, greater purchases by the Federal Reserve. Didn't last that long before they resorted to QE3, which is that blue line, which was unlimited quantitative easing. The Fed came out and said, we're going to purchase assets at a very rapid pace for as long as necessary to achieve our end results. And that, of course, went for a couple of years and added about 1.5 trillion all by itself to the federal balance sheet, the Fed's balance sheet, and was, again, unprecedented, blew everything previous out of the water. Then came the COVID-19 policy response, and you can see that in this red line. This gives a great perspective of how overwhelming this action was, how unprecedented, how it broke all previous records in quantitative easing and really in everything else. It got up quickly to $2.9 trillion in asset purchases by the Fed, which by itself was more than all of the previous quantitative easing programs combined. And it did it not in a matter of a couple of years, but essentially a few weeks. So that's impressive enough, but this is an old chart. Added to that, we have Trump's year-end $900 billion stimulus bill. More liquidity going into the market. And again, importantly, not going to Wall Street, but going more to Main Street. Then we have Biden's $1.9 trillion stimulus plan, which is being enacted, as we can see at this moment. And as we can see, really is just tremendous largesse to a lot of groups that don't really need it. So tremendously stimulative for the economy, and an ocean of money just cascading over the economy. Now, next in this, I think, is going to be a big influence on the gold market very shortly. It's going to help change the theme and the talking points for gold is the infrastructure plan. Biden's looking at $2 to $3 trillion for that. That is this kind of, or supposedly the kind of shovel-ready spending that will really get the economy kicking. We'll see about that, but regardless, it's a lot of money creation and a lot of debt creation. This is another wonderful chart of total Fed assets. You can see how the immediate response, but it's rising still. It's going up. It's well over $7.5 trillion and still headed upward. Again, this is a chart from Incrementum, and it's another great chart that puts things into perspective for us. We can see here, let me go back to that. We can see here that the gold price is, or this correction is very isn't much compared when you look at the big picture. It's not unprecedented. What we have here in this most recent correction is just a little blip downward. And we can really recover from this very quickly. The world gold price is much higher than the dollar gold price. So as you can see from that, it's largely been a dollar story, and dollar strength has played into this a little bit in itself. Now, just to try and paint a little bit of a bigger picture, when we look in a really a more bullish and a better picture, more positive picture for gold investors, all of this liquidity coming into the economy, the US economy, but the global economy, this level of liquidity, this level of spending, all in an environment where, because of the debts that have been created, we cannot and can never again have anything approaching normalized interest rates. This is very bullish for gold over the longer term once we get past this rough patch. What are we looking at for a potential gold price? This chart from Incrementum says that right now, if we were going to just a 40% gold cover of the money in circulation right now, the M2 measure of monetary aggregates, we'd need a $24,000 gold price. If we were just to have a 20% cover, gold cover, it would be about a $12,000 US gold price. So this is where you get those predictions at the end of the cycle that we're in of anywhere from $8,000 to $12,000 for the gold price. And of course, if we get to that level, you can only imagine where we'll be for the mining stocks, and particularly the junior mining stocks. This chart shows too, again from the In Gold We Trust report, this is the current gold bull market in red. And you can see we have not reached the levels anywhere near the peak levels of previous bull markets. We're still at a very low level, and the gold stocks in general are extremely undervalued. Even after gold's decline, they're extremely undervalued to gold itself. So in summary, never make predictions, especially about the future. Where is the bottom? I don't know. I don't believe anyone who tells you that they do know. I would have thought we were very close to the bottom a week ago, 2 weeks ago, frankly, a month ago. I do believe, and it's obvious, we are closer to the bottom than we were last week. That is a good sign. We're going to be at the bottom at some point soon. And the lesson is you can never pick the absolute bottom. You have to look at relative valuations, relative values over the long term. You have to buy gold and mining stocks near the lows. You're never going to find the absolute lows. So I'm telling my readers in Gold Newsletter, this is the time, maybe not necessarily to jump in head first, but this is a time to begin accumulating the better stories, because they're out there and they're on the bargain rack right now. It's a great time to buy and be confident that in a year or 2 years down the road, these stocks are going to be far, far higher than the levels that they are today. It's not going to happen slowly. When it does happen, one thing that this past week on Tuesday, gold popped about $14 on that day. And if you notice the reaction of the juniors, they all soared, as well as the seniors. Mining stocks across the board just rocketed higher very quickly. That's another lesson. FOMO is at work in the junior mining sector. When the turn comes, the juniors will rebound so quickly you'll get whiplash. So try to take advantage of these depressed levels while they last. And the long-term picture, again, argues for considerable multiples, not only in gold, not only in silver, but mining stocks. Silver leverages gold. Mining stocks, particularly the juniors, leverage both gold and silver. So you really want to be positioned in them. So that's me. Gold Newsletter is my publication. You can go to goldnewsletter.com/MIF to get a deal, a half price offer on Gold Newsletter itself. You can, I urge everyone to come to the New Orleans Investment Conference, which I also do this fall, October 19th to 22nd. It will be in person. It's going to be a wonderful welcoming back party for the entire sector. And you can follow me on Twitter. So please do. I occasionally make some comments that make sense. and I occasionally make some that don't make sense. So it's genuinely entertaining, genuinely entertaining. So please follow me there.